Welcome back to the channel. A lot to unpack this week, a lot to talk about, especially as we look to the Bank of Canada policy rate decision coming up on September 4th and the US monetary policy decision, the Fed funds rate decision that's going to be happening on September 18th. And we have a lot of data rolling out right now that can definitely move the markets, especially if we look at the conversation out of the US just last week. Just last week on Friday, we heard from Jerome Powell, the head of the US Federal Reserve, and we heard from him at Jackson Point, the symposium, where the US is about to pivot. They've actually confirmed that they're going to be cutting interest rates.
The time has come for policy to adjust.
This is really good news, not only for Canadians. I mean, this is single-handedly a big move that can save Canada and our mortgage market. But ultimately, it is a tell of what is happening in the US. And what I do want to do is just talk a little bit about the mandate, what the monetary policy decisions in the US look like. We've talked about it on the channel before, but I think it's very important to look at what their mandate is and then what data we should be paying close attention to as it rolls out. So the US Federal Reserve, their monetary policy is based on a dual mandate. They have two things that they really focus in on. One, much like the Bank of Canada, is the inflation, the monetary policy, getting inflation down to 2% target, right? That is identical with Canada and the US. They want to see it hit 2%. And as we start to see the inflationary trends pull back, we start to see that gradual easing in inflation, not only in Canada and the US, but globally. Well, they're pretty comfortable that inflation will get down to 2%. That's what they're saying. And eventually this could take some time. There's going to be some peaks and valleys, some base year effects as we get to 2%, but they're confident that we will get there.
Inflation is now much closer to our objective. The labor market has cooled considerably from its formerly overheated state.
Now, in the US, they have an additional mandate, one that is clear cut, right? Unlike Canada, where we do focus on unemployment and employment, the US actually stipulates that. That's part of their mandate. And that is to have maximum employment in the US. So if we understand that if unemployment rate ticks back up, the central bank in the US has to make a proactive decision. They need to ensure that the majority of Americans are working, especially if we look at the US deficit, we look at the debt crisis in the US, which is in the trillions of dollars. Well, this is a huge factor.
The unemployment rate began to rise over a year ago and is now at 4.3%. The cooling in labor market conditions is unmistakable. We do not seek or welcome further cooling in labor market conditions. The upside risks to inflation have diminished, and the downside risks to employment have increased.
And one that I believe is the catalyst to move the US off the sidelines into a position to cut rates. Now, some may be saying, well, we projected that they were supposed to cut in September. And ultimately, as the US awaited the data, the worsening data of unemployment ticking back up, well, they've now made the move. The question in the market right now is the volatility, right? What's happening in the stock market, in the treasuries, in different markets. Some economists, analysts are saying that, look, the US may have been too late to act, right? They should have acted sooner, because once these unemployment numbers start to tick up, they can really creep up fast. And once that motion, once that movement of unemployment, that sentiment changes, well, it can take a lot to stop that speeding train. So this is where the economy really comes into focus. And as we always say here on the channel, whatever happens in the US, if the US sneezes, Canada catches the cold. But more importantly, other economies in the world get the sniffles. The US is the largest economy in the world. There's no denying that. And ultimately, how is that going to play here in Canada? So we know that on September 4th, the Bank of Canada is now going to be meeting again. This is expected that we're going to have a third cut. Question is, both here in Canada and the US, is how big is that cut going to be? Is it going to be a quarter, 0.5%? I mean, arguably in the US, there's probably a better probability of a larger cut, probably about 0.5% versus Canada, where we're going to most likely see a 0.25%. That's slow and steady, because keep in mind, the central bank here in Canada has already cut twice. It'll be 3 times by the time the meeting happens on September 18th in the US. So we have to understand that that's obviously going to play into the exchange rate between the Canadian US dollar. It's also going to bridge that gap between what the Fed's fund rate is, which is currently situated around 5.25 to 5.5, where we're at 4.5, right? So there's that bandwidth in the Fed's fund rate. And this is where we need to see some little bit of a compression between those two rates. That could help the Canadian dollar, can also help the Canadian economy. And this is why we're sort of arguing. Many would say, hey, the US cutting might save Canada. Because Canada has already cut twice, potentially 3 times ahead of the US, we are going to maybe feel these impacts a little bit sooner. Remember that lag, right? It takes 12 to 18 months for every single monetary policy decision to impact and trickle through into the economy. Because Canada's already cut twice, one of the first central banks to cut, how is that going to fare for Canada in the next 6 to 12 months? So, and ultimately all this, we look at the mortgage and real estate marketplace. Now, the real estate marketplace in general right now is, here in Canada, very volatile. We're seeing a lot of new inventory coming to the market, but I think many Canadians are literally still waiting on the sidelines for that additional support from the central bank, from the Bank of Canada, to see the course of action. Are we going to be on this continuous gradual cut down to whatever the policy rate's going to rest at, right? Whatever it may be. Some are projecting, a full percent by the end of the year, some a little bit more, some a little bit less, but ultimately, are we going to see those cuts? Are we going to have a blip, a black swan event, some cataclysmic geopolitical event that's going to derail that conversation? That's literally what's happening. When it comes to the mortgage rates, ultimately we've talked about on the channel before, and I think it's constantly worth reiterating. The election in the US is going to have a big catalyst on how and what happens with the treasuries, how the US manages their debt, what direction they're taking. Much like here in Canada, we're running a deficit. The US is also, spending trillions, we're spending billions, and that can have a course on the treasury markets, which impact bond prices in Canada. As you recall, the 5-year Bank of Canada bond is the best barometer for fixed rate mortgages, especially those 5-year mortgages here in Canada. So as we await this week to come up and the following couple of weeks, well, we'll see exactly how things unfold, but I think it's important for our viewers to understand what you should be paying attention to, especially if you're thinking about getting into the real estate market, buying your first home, renewing your mortgage, upsizing. These are data points that you can focus on and look at and see what the next set of data could be looking like. Will we see that US data numbers, those unemployment numbers tick up? What will happen next? What will happen with inflation here in Canada? How much you think Canada, the Bank of Canada, is going to cut on the 4th? Is it going to be 1/4, 0.5%? What do you think is going to happen? Let us know in the comment sections below. Don't forget to subscribe. But once again, thanks for stopping by. Wishing everyone a wonderful Friday and an even better weekend ahead. Thanks for clicking.